Today's episode of Market Talk is brought to you in part by Growmark FS. Keeping up on the latest in ag is a challenge to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic grain and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And good afternoon. Welcome into Market Talk for this Wednesday, August 25th. Great to have you here with us. I'm your host, Jesse Allen. Thanks for joining us and making us part of your day as always. Find us online, markettalkag.com. That's our home on the web, markettalkag.com. All of our streaming sources are there. You can download and subscribe to the podcast each day and all of our updates on Spotify, Apple Podcasts, iHeartRadio, SoundCloud, so many more. All the details online, markettalkag.com. Well, we had a surprisingly decent day today, despite maybe some bearish news in the market. Quarter beans finishing slightly higher. Got plenty to talk about. Let's bring in our good friend Mike Zuzolo with Global Commodity Analytics joining us here this afternoon. And, Mike, we talked Friday and, we were talking, I know you made the joke that it was kind of a bearish day Friday. And so everyone's like, oh, Zuzolo's probably on. Well, today you get somewhat of an up day. Talk about just in general, before we break this down, your thoughts on Wednesday's close, sir.
Yeah, I thought three things really drove Wednesday. Number one was the wheat. It was the one that continues to suffer. And I think this really can be laid at the feet of what's going on over in Europe and what's going on with the currencies right now. And we talked about that on Friday as well, Jesse. And what we're seeing in the European Paris wheat futures is a major break to the downside. We've gone from about $9.10 a bushel in US dollar terms all the way down to about $7.80. So we've had almost a 15% break just in 1 week. And I think that's mainly the funds jumping out of the market at this stage. I'm not sure if that's because of a seasonal or whether they're seeing something over there as far as a slowdown in demand, or whether it's more macro related with the currencies and a little bit of nervousness ahead of the Jackson Hole meeting here by the Federal Reserve, which we can talk about in a couple minutes if you like. But wheat is still my leader. And so that's one of the things that I really want to have shape up and find some support and help drive the corn up to that next leg higher. Second thing that drove the market was the difference between the corn and the beans in terms of percentage terms gains. And I think that was because the U.S. bean belt is looking at some pretty good chances for some pretty good wide area rainfall. Two big systems expected to come through, one pretty much on top of us as we close out the week. The second one follows pretty much right behind it as we get into Sunday, Monday. And so I think the bean trader who was long yesterday felt really good about the jump technically and the support levels holding in that big fat crude oil market and unleaded gasoline market rally. Probably wanted to take some money off the table on the weather at that stage. Third thing was ethanol, and where did we come in on the weekly numbers for ethanol, and what did that mean to the corn market? And at first glance, we saw production numbers go down. We saw also stocks go down, and stocks right now in ethanol are their lowest since July 4th. And so it's hard to say whether it was a good report or a bad report. But then it was interesting. Right after that report came out, I got a call from a client on the Indiana-Ohio border, closer to Cincinnati, Ohio. And he said, my ethanol bid just jumped. I'm back up at $1.50 plus on spot corn for ethanol right now. And it got me thinking, and it got me looking. There's a lot of bids out there at $1.50, $1.60 right now for spot ethanol in the Eastern Corn Belt, and maybe a little bit less in the Western Corn Belt. But the point being is the break in the supply and the break in the production related to just an outright tight supply of corn that ethanol producers and blenders and refiners, I should say crushers, are not getting right now. And I think that's a really big point, because the two biggest things heading into the end of the week and heading into September is on the micro level, supply demand in terms of the September delivery and what we look for when September futures goes into the delivery with that cash price versus the futures price. And then the macro side will be the Jackson Hole meeting and how the dollar reacts to what the Fed says at the end of this week.
I want to stay on that ethanol train a little bit here, and on the video screen, I'm going to pull up ethanol production, and you mentioned that drop that we saw today in the report for last week, and I know that caught the trade by surprise. So maybe expand upon your thoughts here with ethanol just a little bit more, and talk about how these numbers tie in with what you were saying about that tight corn supply, Mike.
Yeah, that 933,000 barrels a day is what we're moving in terms of production, in terms of our crush for corn. That's going to be down about 4% from last week, and that's going to be the lowest number since March. And that's what this chart really shows up nicely is we are, and this is where I go back to that this is not a good chart to look at if you're excited about ethanol and the corn demand, because you're now back to levels that you are producing coming out of COVID instead of way out of COVID and COVID well in the rear view mirror. We're actually going the wrong way in the production cycle. And when I see this chart, Jesse, the first thing I worry about is the issue of EPA maybe giving an out to the refiners through different blending credits and exclusions in terms of blending ethanol into unleaded gas. And this goes back to what Senator Grassley from Iowa said last week when that letter was floating around. He said, it quotes, the EPA is giving a gift to big oil if this letter is correct and this recommendation is correct, and is playing games with the RFS standard law. So that's the half of the chart picture that I do not like. And then the stocks number, though, kind of solidifies maybe the idea that we just don't have the corn out there to be able to get after it, because this stocks number being at the low since July 4th and going through that 52-week moving average, which is the squiggly blue line, we're now back below the 52-week moving average in stocks of ethanol. So we must be using it someplace because the stock levels are going down, even though production levels are going down. So this is why the September delivery of corn and the fact that we're trading $6.50 to $7 cash corn right now against a $5.50 futures price, I think it has a lot of meaning the first 10 days of delivery, especially.
Well, Mike, talking corn, looking at these ethanol numbers, and you mentioned, some of that cash trade and where we're at with futures right now. Let's talk. Let's talk December corn puts and go through this chart with us here. We have on the video screen, and just talk about your thoughts with this and maybe this strategy right now.
Yeah, kind of combining what we talked about last week with the idea that I'm still stuck at a 175 national yield. So I'm not really eager to sell a lot of cash bushels of corn unless it's for catch up or unless it's in somebody's area where they just see almost a near record corn production number. So that's what I'm looking at as far as buying puts instead of selling cash, especially on the last 50% of sales that I've got for brokerage clients and the last 65% of sales for the cash only clients I work with. So what I do, Jesse, is I use a rule of thumb that implied volatility, and that's your purple line, and it's going to be the left hand side of the y-axis, or the 28%. That's the percentage of implied volatility of this 550 December corn put. And what I generally go by the mindset of is option volatility is almost just like actual flat price. You buy low and sell high. So if you're going to buy an option, you don't want to buy an option where you're at 42 or 43% volatility like we were back in June of this past year, unless you buy an option and sell an option and kind of offset that. And that's what I was doing. Now you've gotten literally broken the volatility back by almost 15 percentage points just in the last month and a half, 2 months. And so now you got back to a level where the 28% option volatility in this 550 corn put is at its lowest level since March, April. So it's back to being a friend to a buying of an option mindset. So then we take a look at the flat price of that 550 put, which is the black line on the right-hand side. You're trading about 30 and a half cents at this point. You're getting down close to the major lows from the spring and also that low in August. So this is what I'm kind of sending out to clients and subscribers, kind of laying in the weeds, waiting to pounce on this put when both these lines come together and are satisfactory for me to say, okay, this could be a good recommendation and good hedge.
Mike, I want to touch on weather here real quick before we move to maybe talk some outside markets and that Jackson Hole meeting as well. And you mentioned the rains. We're watching those here to end this week across much of the northern belt. We have a lot of heat in the south. That's giving us some stress. I even heard maybe a little bit of crop damage from Tuesday afternoon's weather in parts of Iowa, Minnesota, Illinois as well. So, talk about what you're hearing with the weather situation, how that's playing into our markets, especially again that soybean side where we could really maybe see the rains possibly come in at the very last second to help us in some areas.
Yeah, I would put a number on it like this. And everything you said, just excellent reporting on that, Jesse, because that's exactly what I'm hearing as well. But I would put a number on it that clients in Kentucky, Ohio, Indiana, and good areas of Illinois have all reported to me within the last 3 days or 4 days since we spoke at the end of last week and said, I've got about a 4 or 5 day window, I think, on these beans to really help push the yield if I get the rains. And so this is one of those $1 billion rains for soybeans in the Eastern Corn Belt and the Eastern Bean Belt, if you ask me. Corn is probably too late for most of the potential out there. It can, though, save some test weight. And I think that's what we're enduring here in the Western Corn Belt from essentially northern Oklahoma through most of Missouri, Kansas, most of Nebraska, most of South Dakota still, and still that southern half of Iowa. Is I think we're losing test weight by the day with these temperatures and these heat much below 80. Last night at 11 o'clock, I think we were at 84, 86 degrees heading into the 11 o'clock news. So, I mean, this is just not going to be good for the test weights, I don't think, in the corn. But in the beans, I think this rainfall could really help preserve both test weights and add some pod fill and maybe get an extra bean on that fourth pod if it's got it developing. So that's kind of the line that I have in the sand for this week, that after this week, I think we're going to see a lot of change in the physiology of the plants, where we're going to start seeing color changes and leaf changes in the soybeans, and you're going to see the corn really dry down fast.
Mike, I want to talk the outside markets, and I know you mentioned that Jackson Hole meeting, and I know we quietly made some highs in the Nasdaq and S&P, I believe, here yesterday. And I know you got an S&P chart. I'll pull this up on the screen, but let's talk about just that meeting coming up, some of the thoughts heading into that meeting, and some of the things you're seeing in our outside macro markets as we have that relate to commodities right now.
Yeah. Real briefly on this chart, it's a neat chart because it answers a big question for clients. I'm jumping into the S&P E-mini puts at this point for hedging financial needs. So if you're in the stock market, I think there's a window here that I'm nervous about a break to the downside because of the Jackson Hole meeting, and it coincides with and dovetails with new record highs in the S&P 500 this week. So I think this market's just way too rich at this stage, and that if the Fed says anything wrong, the equities markets will jump. And usually, seasonally, not always by any stretch of the imagination, September is a tougher month for the equities market. So that plays into the role as well, along with some cycle work I do, Jesse. But this chart shows you the exact same strike price of a 4,200 S&P put, E-mini put, one SEP, one DEES. It's hard to do S&P mini puts because there's no other contracts in between September and December. So those are the futures months you have to deal with. Those are the puts you have to deal with. And so these E-mini puts, they really jump and jump in price. And so what I'm getting at is the September S&P put has an expiration of about 9/17, September 17th. That would suggest I'm not going to have enough time, but I don't want to go out and buy the exact same put for $88 when I can buy a September for $11. Why? Because you see how fast these puts erode if the market goes sideways or higher. So I think I'll get a second chance to jump into the DEES puts at a cheaper price and not have to spend any more for the clients than what I would have originally. So I get two shots for the price of one is my logic. My mindset is pretty simple. I think the Federal Reserve is less worried about inflation until this major super big $3 to $5 trillion bill in the House and Senate actually passes and we actually know what's in it. But for this week, I think they're more nervous about the financial markets getting too rich, and they're going to talk more about tapering and more about taking the punch bowl away from the equities markets. And that's why this, I think, is a good effective hedge. And if I'm wrong, that $11 or $11.25, you just multiply that by 50, you add the commissions and costs in it, you're talking about maybe $600, $700 of costs that you're protecting a pretty big downside for the next 20 days.
A lot of things to consider there, and I'll be interested to see what those headlines are coming out of Jackson Hole for sure. And as we move into the month of September, it'll be pretty key, I think. Let's move over to livestock here, Mike. And looking at the cattle market, we've seen cutouts now start to maybe slip just a little bit. They
Mhm.
skyrocketed higher. We saw a little weakness in the cattle market here today. Talk about what you're seeing over in cattle. I'll pull up this chart you have for the October cattle contract as well, but. Just talk about what you're seeing and your overall feel in this cattle market right now.
Real similar to what we talked about Friday. I liked how we got that push in the cash market. It looked like we were going to get that seasonality of that last summer holiday, but I think we pushed it to the edge. The funds are long enough, and I'm starting to get sell signals now on the technicals, and I feel like the seasonals are going to start working against us at this stage, especially given the discount in price of hog futures versus the cash index in hogs. We're talking, 107 on a cash hog index versus 87 in October now lead month futures for hogs. So I think that may play a more negative role in the cattle because the pork margins are going to improve, I think, here going forward, Jesse. So this chart shows the sell signal that I'm talking about. We made a lower low. We've got a gap below the market down around that 129 area. That's kind of the old breakout area. And then you've got that big moving average. It's been a really big backbone to the October contract around 126. And so I'm kind of thinking that, okay, get the hedges in place. I've been doing that. And let's see what the market does after the gap. Let's see what the cash market does. I wasn't real pleased with the central stockyards numbers again. We did barely any trading at all in the cash market there. And all we did was sell heifers at about 121, 122. So I do think the cash market's starting to dry up a little bit too much to satisfy the funds who are long at these price levels.
Well, I've been hearing some thoughts though that we're maybe getting current out there in feedlot country, and that could maybe give us a little leverage against Packers. But I'm a little curious about that just with some of the market action I've seen. And to your point, that pretty weak Fed cattle exchange auction today. So I'm kind of curious if that's really the case, if that's really happening out there in the countryside, Mike.
Yeah, and I think we've been able to price that in through the cattle on feed report last Friday. That was such a bullish report when it came to exactly what you're talking about. We had our shot to take these markets higher on that cattle on feed report, and we took it. And I think it's priced in at this point. And if I'm wrong, it's still a really good hedge. I want to say, based upon a couple calculators I use, we're probably at the best profit margins right now for finished cattle heading into October that we've had all year long. So when you get to that kind of profit per head, I talk about profit per acre, profit per head. You get to these kind of prices, you just don't want to let those go. And if you're wrong, you're going to be really laughing all the way to the bank, so to speak, because that hedge is going to be more than offset typically with a really good cash sale.
Mike, let's touch on hogs as well. Hogs were higher on the day Wednesday. There's talk out there of maybe some higher cash prospects, but on the same time, we're kind of being held down by a little bit of uncertainty with cutouts. I mean, what's your thoughts here in hogs right now, Mike?
I still put the hogs right at the feet of the Chinese demand on the export front. As long as they keep buying, Jesse, I think we'll have a tight supply, and the cutout break that we've had is actually healthy, along with the cash index staying elevated versus the futures market now that August has gone off the board. But if we see bad export sales on, especially to China and Mexico on Thursday morning, then it can open up the downside in the hogs because we really are getting back to kill and slaughter levels that are probably at the demand. We're probably meeting the demand with the kind of slaughter that we did, especially last week. We had a nice big jump in cattle and hog slaughter last week, and we got close to back to last year's levels year to date.
Mike, great insight as always. Any other final thoughts you have for us today? Anything else you want to reiterate?
Yeah, just to kind of polish up and finish off that Jackson Hole meeting, because we talked about the S&P, Jesse, and the equities markets. To me, the Jackson Hole meeting means a lot about the dollar because it means a lot about interest rates. And so we got a real breath of fresh air with the pullback in the dollar and it hitting resistance. Those highs in the dollar index that we put in earlier this week, those are really crucial as we close out this week and go into next week once we know what the Fed is thinking.
Mike, I know you have great insight and analysis and can help folks if they need the advice. And I know that free trial on your website is a great place to start, isn't it?
Yeah, it really is. I'd really encourage you because I've had a couple new guys sign up and get a trial, and they've had a couple questions. I have no problem answering questions for specific needs so you can get an idea of what I do. Go to globalcomresearch.com, globalcom with two M's, research.com, and sign up today.
Mike, appreciate the time as always. Thank you, sir, and we'll
Yes,
talk
it's
again
great
next
to be
week.
with you. Thank you.
Mike Zuzolo with Global Commodity Analytics, our guest today here on Market Talk. Find us online, markettalkag.com. This has been the Wednesday, August 25th edition of Market Talk. I'm Jesse Allen. Have a great afternoon.